there is a problem, I think, in the intellectual framework or model used by many economists or even central banks, where they assume that, a bit more monetary stimulus and let time pass a bit, and the headwinds in the phrase which are holding the economy back will just go away of their own accord. The assumption behind the sort of models that central banks use is that the things that are somehow impeding growth will go away with enough patience and enough monetary stimulus. And I think that is false. And it doesn't give enough credit to the problem of the need to change the disequilibrium in which we've now found ourselves and get to a new equilibrium. So what will lead to I think, ultimately to a change in policies is what I call, it's the title of my last chapter, which is The Audacity of Pessimism. And I think that as governments come to realise that actually central banks aren't the only game in town, and they don't have the answer to this, it's not the fault of central banks, just that monetary policy, like the cyclist cycling up the hill, is just getting exhausted. It can't get you over the, where you want to go. And therefore they'd be willing to adopt the measures that, they understand are the right thing ideally, but there's a cost politically to achieving them, but they'll be driven to achieve them because in the end it's the only way they'll be able to get back to a sustainable growth path. And now, it may well be that takes so long that we actually have another crisis before we get to that point. The hope of my writing the book was that in part people would start to think about this and not have to go through another crisis before we did what was necessary. But we're well on the way. I mean, I think it is very revealing that it's come as a great surprise to most central banks that 8 years of this enormous degree of monetary stimulus, they'd all assume that we'd be back to normal by now. But we're far from being back to normal. We don't have a sustainable recovery. And monetary stimulus doesn't look as though it's going to achieve it. So it does need something else. Do you think the experience of the crisis has brought home to bank management that it's not actually terribly sensible for them to run an institution where they let physicists and mathematicians run amok and they have no control about it? And there's a story in the book about Dennis Weatherston, who was British-born, came to the US for JP Morgan and rose from being a junior clerk to being the chief executive of JP Morgan. And this was many years ago. And he had a rule that when people invented a new product, then he would give them 15 minutes, 3 times, to explain what this product was to him and the senior management committee. And if at the end of those 3 sessions they didn't understand the instrument, then they weren't going to sell it. It's a little bit by the application of Warren Buffett to investment. Simple idea. Warren Buffett does not invest in things he doesn't understand. And of course the great temptation of many people is that you imagine yourself at home on a Saturday afternoon and you look across the hedge and your neighbour appears to be getting more and more wealth and they're putting new things in the garden and they go off on exotic holidays. And you ask them, so how are you doing this? And they say, well, I've got this fantastic investment advice and these are the products. You should buy shares in these companies. And the temptation is to say, well, initially you might say, I don't really understand it. But this person getting wealthier and wealthier, well, there must be something in it, so I must join. And there's a great temptation of institutions to join the bandwagon, not least because if you're actually a bank and you don't join the bandwagon, you may actually end up getting fired for earning much lower profits until, of course, the final collapse comes and it's all revealed to be a sham. But, of course, it's too late to get your job back at that point. You've lost it. And I think there is this, one of the examples of, whether you call it hubris, but certainly in a period when nothing seems to go wrong, as happened in the great moderation, the great stability, nothing happened to demonstrate to people that they were taking serious risks. Whether it was in banks, whether it was the unsustainable build-up of credit, you couldn't see any evidence that what you were doing was a mistake. All you could see was if you didn't join the bandwagon, you didn't do as well as everybody else. And then it's not so, I don't think you should criticize people for that. This is what I call in the book radical uncertainty. We don't know what's driving the world. You know, Donald Rumsfeld had this phrase, unknown unknowns. This is the fundamentally important thing. But I prefer to call them unknowable unknowns. Things that we can't imagine, but turn out to be real problems.